Hi, folks. Today's lesson is going to be split into two parts. And just they're not terribly long, each one of them. It's just that they concern two very, very different subjects. So today we're going to talk a little bit about equity transactions. So now that we've kind of learned the expanded ledger, we're going to talk a little bit about what some of the transactions are going to look like. So, we've already done a few of these with the guided practice, and as we can see, for the most part, the rules haven't changed. We're just being a lot more specific about which accounts we're using. And so we're going to see that really except for investments or any unusual transactions, over time, the equity account or the capital account is actually going to stay fairly unchanged over the course of the year. Where things will change a lot is with in terms of values, is with the expense and revenue accounts, and then we're going to see with the closing process how at the end of the fiscal year those two things are used to calculate the change in capital. So remembering just a few rules then, the capital and revenue accounts, which help the value of the business, they increase with a credit on the credit side of the T account. And so they would normally have a credit balance. Drawings and expenses, on the other hand, which decrease the value of the business, which is a little bit counterintuitive. They decrease the value in business, but as they kind of add up over time, remember we talked about those expenses adding up, we do that with a debit to those accounts. And so we would normally expect to see a debit balance on those accounts. Now, we should look or learn to look for certain patterns. And it's just really adjusting the patterns and the things that we've been using so far, just to include the new accounts as opposed to just always doing it into capital. So for instance, if we sell a service and cash is paid, then we are used to debiting bank, but instead of crediting, having a general credit to uh, um, capital, it's going to go to the appropriate revenue account. On the other hand, if that purchase is made on credit, it really hasn't changed. It's still going to be an account receivable with whatever customer's name it is. And then again, we're going to credit the revenue account instead of capital. Now, if we get a bill, so we are receiving a bill, I think I mentioned this in a previous lesson, it's kind of like a legal requirement to pay, and it becomes something that accountants have to put on the company books right away. If, and sometimes in your transactions you'll get this, but in real life it's actually fairly rare. But if a bill is received and it's paid immediately, then I think we know from experience that we're going to credit our bank account because the cash is going to go out. But this time, instead of debiting the capital account again, we're going to find the appropriate expense account, which would be like a telephone expense in this case. Now, usually, as I said, a bill is not paid immediately. And so what we do is we kind of put it through a process where it becomes an account payable for a short amount of time until the right people get involved and the right paperwork gets done, and then a check is paid. So what will happen is then on the day that the bill is received, we are still going to debit the telephone expense. Uh, and we will credit the account payable. So our account payable, our liability is going to go up by the value of the telephone expense. Now, when you see instructions then to turn around and pay that telephone bill, a lot of people want to reprocess it through the telephone expense account. And I always ask those students, like, if it was your cell phone bill, would you want to be paying it twice? Well, the answer obviously is no. Technically, in our books, even though we haven't paid the bill, we have recognized that expense, and that's really all we're doing at this point. Later, when we actually do pay the bill, this account payable is really the holding place for that money that we owe. So we recognize the expense and we hold that value in the account payable. Now that we're paying it with actual cash, obviously our bank is going to go down with a credit, but so is the account payable, because that's where we've been holding the value of that bill that we haven't paid. So our account payable to the telephone company is also going to go down, which is a debit as well. Drawings transactions are pretty straightforward. In this case, we have this quote unquote fictitious business owner named Bill Gates, B. Gates. And as the accountant, we would expect them to go through whatever proper process there is for withdrawing money from the business. But if they're the owner, they can do that anytime. There are pros and cons to doing it, but as long as they follow the proper procedures and provide you with proper paperwork, they're quite welcome to do that. Typically, when we do this, the owner will take that value out in the form of cash. So our bank is going to go down, and so we're going to have a credit for that. What this also does, though, is it increases the value, the total value of all the money that the owner has taken out. And so since it's an increase in kind of like an expense in a way, it decreases the value of the business. So that's going to be a debit to the drawings account. Now, as I said, this is usually done through a check, but technically the owner can withdraw more or less whatever they want. There's kind of loan and mortgage issues perhaps at play, but they can take out more or less whatever they want legally. The difference would be, though, that instead of using the bank account, it would change to whatever asset that was used as payment to the owner. So if the owner wanted to take out $100 worth of office supplies, they're more than welcome to do that. What would change then is you would still debit B. Gates Drawings, or whoever the owner's name is, and you would credit office supplies instead. So that's the end of that part lesson. The next part is going to be on accounting principles related to income.